Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hunt of Pacific Private Money, California's fastest growing mortgage investment firm. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. You got it. We're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Their only request, a $75 cleaning fee to cover those housekeeping expenses. Check them out at lighthouseresortandmarina.com. You can also reach them at 916-777-5511. Today's trivia theme is TV pets. It'll be kind of cute. Listen, Brad, you should have been here last week. I was doing theme songs from TV shows.
And he was singing them.
Singing them, yes.
Thank God we have a different topic.
Yeah. Thank you very much. Okay, our website is bestofinvesting.com. Check us out on Facebook, YouTube by typing Best of Investing Radio Show, and also watch us on television, Comcast Channel 26, AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Today's special guest is Brad Rogerson, who is an attorney. But he's not just any attorney. He's a real estate and finance attorney that's been practicing law in the Bay Area for over 18 years. A large portion of his practice focuses on private lending and real estate investments, including joint ventures, real estate syndications, mortgage pools, real estate funds, and other real estate-related securities offerings. Brad's clients include real estate developers, finance companies, private lenders, investors, and serves as securities counsel to the California Mortgage Association. So he's a big wheel. He moves in circles. Mark, go ahead and take it away.
Well, my first question for Brad is something we're all trying to figure out here is what's looking ahead for 2015. Do you or your clients have any outlook for what the real estate market's heading next year?
Yeah, well, people seem to be, bullish still, I have to say, in terms of there are a lot of clients coming in and investing and thinking that they are going to have values well through 15, and there is no doomsday scenario that people are thinking, at least that I'm seeing at this point.
Well, and you have a personal story about why you think the market is still pretty bullish.
Yes, that's because I've been trying to buy a house in this market, and this market is crushing me. And it's because there are apparently a lot of people out there with, $1.3 million, $1.5 million in their pocket that are willing to put it down, buy all cash, and do a 7-day close. And I, for some reason, can't compete with that. I'm in the wrong business.
Tough. So wait a minute. So what market was this offer you made in?
Well, it's all been around Marin. It's all been in and around. Nothing in Mill Valley. Can't even touch that place. But
you can buy
around
10.
San Rafael, yeah, exactly.
So San Rafael home, you put an offer in, and you got beat by an all-cash $1.3 million 7-day close.
Yes, 7-day close.
So that means that they didn't even have time to do inspections, really.
Yeah, well, we think as the seller, it's tough for the seller because if they're not looking at anything, and so they're going to get sued if they find something in the end. The seller should be saying to them, hey, I want you to take a little look at this so that I'm not,
Well, that's a good point. So he can't just sell it, quote, as is, can he?
Well, they try, and they will. And in this market, though, people don't seem to care. They just don't seem to care that, the buyer side, they're like, if I find, another $25,000, $30,000, $50,000 work needs to be done, I'll eat it. And that seems to be what's happening out there.
So we were debating before the show, who would pay $1.3 million all cash for a house? If you had $1.3 million or more in cash, why wouldn't you buy a fancy house in Tiburon or in San Francisco for $3, $4, $5 million? And your guess was that it might be.
Well, my guess was, and it was after beating my head against the wall several times, because I was like, why are the people with $1.3 million in their pocket, competing against me for a $1.3 million house? Why aren't they out buying a $4 million house or, have 20% of a really, really big house? And so it just made no sense to me. And finally, I was talking to one of my actual mortgage broker, who had just told me she'd come back from an economist talking about all of the money from China that is coming here, that people are moving over here, and they're coming with just cash. And it clicked in my head, having done work with the EB-5 program, which is a program which allows people to get visas if they invest certain amounts of money in projects that will create certain amounts of jobs. And overwhelmingly it has been used by Chinese residents that are coming over here, and it just clicked in my head all of a sudden that this may be driving all of this cash.
So these people are not moving into the house; they're just buying it for investment.
No,
purposes.
they're moving into the house. The investment side is that's how you get that. They're coming in and investing in projects, and we're talking millions and millions of dollars that you have to invest, and they're not really caring about the return, because what they get in return for making the investment is a visa. They're not. So
But
developers
also,
love it.
you know, Chinese people as a culture, though, because they've been around for thousands of years, they seem to think very, very long term.
Yeah.
You know, so they'll be okay with a low interest, low rate of return on an investment if they're going to be buying like investment property.
Right. And I heard a statistic, and I'm not sure if it's 100% correct, but that China had like 3 billionaires 10 years ago, and now they have 300 billionaires. I mean, it's the amount of money that is now being consolidated, and the ability to come over and spend it has changed, I guess, immensely.
Well, Bradley, you also do syndication. So, are you seeing a lot more, money flowing into like real estate related type of investment pools and funds, like mortgage pool funds and development funds?
I'm definitely seeing a lot of the issuers wanting, a lot of guys getting into the business, and a lot of guys that may have not been through the tough years, starting out now. And it's really interesting having done this, and you've seen, I've formed a lot of mortgage pools, and these are pools that they go out and they raise money from investors, accredited investors, or people with the means to invest in these type of investments. But they were always started out as being the mortgage lender first, and this was a way for them to fund their mortgage lending and what they had been doing as mortgage lenders and private lenders. Now you're getting a lot of guys that are coming at it from the MBA standpoint, is what I call it. They're the finance guys, and they understand the fund side of it, but not necessarily the making the loan side of it.
Oh wow!
That's
dangerous.
Yeah, it changes it quite a bit. They're very good at forming the funds and finding guys to pour a bunch of money into it, but they haven't gone out and learned how to make loans and underwrite loans and really understand the risk of the loans. And I also think they don't realize it, especially right now, which goes back to kind of maybe the bullishness of the market. There's a lot of competition for loans right now.
Well, that's the thing, is if they raise too much money, I mean, it is going to drive more competition, less product out there.
And we're already seeing that. I mean, we're seeing, I know of one company that just got a huge influx of cash, and they got to find somewhere to put it. So
yeah, it's interesting though. Mark's company is almost, I would say almost the opposite, but the thing is, you have just deal flow up the wazoo.
Well, in private lending and in all real estate lending, the golden goose is the deal flow. If you've got that conduit, if you've positioned yourself and marketed yourself, or you've got referral resources that will bring you deal flow on a daily basis where you can analyze loans, then I mean that's the key. And what you're talking about, Bradley, is I'm seeing it too. Is there's people are calling it, well, hedge fund money's coming. I don't know where it's coming from, but there's a lot of big tranches of money, not the stuff that we work with. We work with $1 million, $5 million, $10 million tranches in our business model. Other business models are looking at 50, 100 million, 500 million, $1 billion. I mean, large sums of money that Wall Street money that they're trying to put to work in real estate to capture those higher yields. But guess what? The sponsors of those new pools of money, they don't have the deal flow. So they're out there running, they're putting up internet websites. You've got these, lending home, lending tree, lending this, lending that, but they don't have the deal flow. You can't just put up a website and business will come. It doesn't work
Do you
out.
think it's going to be similar to, where the 2005, 2006, where the banks were just free with money? Do you think some of these guys, they're just going to be looking at this money and going, gosh, we're going to place it somewhere?
See, that's the thing. I don't think so, because when you have that much money to put out and you're trying to create a statewide or even nationwide lending model with private capital as opposed to bank capital, and you want to play in that space where you're lending money at 8 to 10% or even higher, the challenge is that business model succeeds better when it's local, when it's a local mortgage broker working with local borrowers in a local neighborhood like we do at Pacific Private Money. We're very local. We're Bay Area, Northern California specialists, and so we can make decisions fast. we can compete with those bigger companies that have more capital because they end up having to be more bank-like because they're not in the neighborhood. They're in Southern California or they're in another state, and now they have to order all the reports. You have to provide them with tax returns and other information. In other words, they have a much larger due diligence requirement in order to put that money out. Otherwise, they would be losing the money. There'd be a danger to their investor capital. So, really, it's interesting to see that, and it's not competition for us because
No, not for you, but I just kind of wonder if they're going to lower their standards because they're going to see so much money on the balance sheet.
Well,
Tell you
I
what,
think you almost have to when you're trying to get that much money out.
that much money, yeah. Especially
it
if they
will
have
be
all in
interesting
one-
to see if
one
they
tranche.
lower their standards or give the money back.
Yeah, yeah, they don't like to give money back. Okay, we're going to cut to our first commercial break, and again, the theme is TV pets. What was the name of the dog on the TV show Married with Children? Remember that show?
Yeah.
Pig. Okay, don't say anything yet. I'll let you answer when we come back from break, okay? I've had that before. We've had guests on. They immediately answer the question. Go, don't do that.
There's
We
no
gotta
buzzer here.
Yeah,
It sounds like you're asking me the question.
No,
right
exactly.
now.
Yeah, we're asking the audience. Okay. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What was the name of the dog on the TV show Married with Children? Stay with us. The Best of Investing. I'll be right back.
I can't remember the name of it.
That's good. No,
I have
I
no
can
idea.
picture him. See, but we, I try to answer, I try to ask questions where that's exactly the response that I hope the audience has. Oh,
What
was
is that?
Because then they want to
They think about it,
They
yeah,
want to
yeah.
stay tuned and listen
that's
to all the
true.
commercials and stuff. Or if it's
No, I can hear Peg saying it.
yeah. They're gonna hear Al saying it.
Yeah.
Al, that's right.
There you go,
Yep.
Peg. What can we do for you, pumpkin? Remember that?
I think he's great on Modern Family.
Yeah, I've only seen that show once, but it's pretty good.
It's funny, yeah. We've got good writers.
You got to give it to that guy now. He's got a whole other successful one with
Yeah. Modern
Family.
Yep.
Yeah.
Yep.
Do you have any fun stories for us about, putting stuff together? Or, because it's trying to think.
Oh yeah, mortgage funds are hilarious.
That's what it's up, but it's like you got this.
You want to pay out what in pref? And keep how much of the profit?
Just
Why they
or
don't make
maybe-
the
Well, when you're putting these things together, it's like to tell the audience what they should be on the lookout for.
Yeah, I mean they're especially these days. I mean, we can maybe briefly touch on the people are going to start advertising these things.
Oh yeah, exactly. Okay, here we go.
That's a good. Yeah, I can come up with a question on that. That's good.
I'll-
Okay.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hans, president of Pacific Private Money. When we cut to the first commercial break, we asked this trivia question. Again, the theme is TV pets. What was the name of the dog on Married with Children? Anybody?
Drawing blanks.
Drawing blanks.
Not remember.
Okay, what stops here?
The buck.
The buck.
Oh,
There you
that's
go.
right.
Okay, and before we get back to Brad here, I got a quick little promotional thing here. Last week we said we were going to have a special trivia contest where the winner is going to get an overnight stay at the West Sonoma Inn and Spa.
Nice.
So whether you're ready for an excursion into the Sonoma wine country or to enjoy the peaceful natural beauty and tranquility of the area, check out the West Sonoma Inn and Spa, a Russian River vacation resort. Enjoy Sonoma County wine tasting, canoe or kayak on the Russian River, or just relax by the pool. Choose one of our spa suites and unwind on the balcony in your own private two-person hydro spa overlooking the vineyards. I'm sure wives were here listening to this. Check out WestSonomaInn.com for room rates and specials, or call 707-869-2874. Here's the question, and I'll give you the rules. Only 1 in 25 guys owns one of these. What? Now, here are the rules. You need to, first of all, no previous winners on the Best of Investing. You need to email Edward at bestofinvesting.com the answer by midnight tonight. and we'll read from amongst the correct answers randomly, and we'll choose somebody, and we'll read that next week. Okay, so that's for the West Sonoma Inn and Spa. Check them out at westsonomainn.com. All right. Now we have Brad Rogerson, a real estate and securities attorney here. And Mark, you were going to ask a question.
I do. So Brad, you help mortgage loan originators and other entrepreneurs create mortgage pool funds from which they can consolidate people's investments and lend that out on real estate loans. This is not a new product, but what's interesting is it just a little over a year ago, they allowed sponsors of these mortgage pool funds now to advertise these things. And so we're starting to see more and more of these things pop up on the internet and in newspaper ads and such. Do you have any advice to someone who's considering maybe investing in a mortgage pool fund, how they might, how would you compare and contrast maybe one over another, or things that they might want to be cautious or
These
wary
things are
of?
pretty thick.
Yeah, no, definitely. I know. I write them, so I know.
Yeah, 45 pages is the average PPM of that.
You don't charge by the word.
No.
Okay.
Well, yeah, I can tell you. It's interesting because it was a big deal when the SEC announced that all of a sudden private placements that people have been used to, the accredited investor offerings for all types of different offerings. It wasn't just mortgage funds. It was any type of fund that was using that exemption. All of a sudden, they say, oh, you can advertise subject to certain additional conditions. And there was this sense that there was going to be a just floodgate of advertising all over the radio, all over TV, all you're going to see, and it really didn't happen. I mean, you're seeing it more, but it was much slower than people thought.
I'm going to guess because it still has to be for accredited investors.
Yes, and they all of a sudden you had to verify that they were accredited, and you had to do that by getting more personal information from the investors.
Remind the audience, the audience, not all of them know what accredited means.
Accredited investor is someone that has $1 million worth of net worth, and that was changed in 2010 to exclude your home. So if you had equity in your home, you couldn't use that anymore. Or you have $200,000 gross income a year, or $300,000 gross income with your spouse.
What if you're self-employed? Do you still get to go gross income, or do you look at net Schedule C?
It's not as specific as that, so it would be gross income.
Oh, that's pretty easy then.
And you're not. It's not like a loan where you're having to check and they have to show ability to pay. But what they do have to do now is the issuer actually has to verify that in some prescribed way. And there are different ways you can do that. But
the box boy at Safeway. Is that
he's accredited.
Yeah.
So those people who are putting these funds together, they have to now verify or qualify, is another word I guess for it, a person who is interested in investing. But looking at it from the consumer side, from the person who's got money to invest, let's say they do qualify, they are accredited, they do have $1 million net worth, but they're looking at some of these what look like new types of investments, but they're really not, because they've been around for over 100 years, but for the last 70 years up to September, October 2013, you couldn't talk about them publicly, you couldn't advertise them.
Right.
So what would you advise? How do you assess the viability and the safety and security features of these types of investments?
Well, as we kind of talked about before the break, the biggest thing I think we do look for is experience and someone who's been doing this, because it's the money raising side is easy. The hard part is making that money work, and that means making good loans, and that means having done it for a while, having, like you say, a pipeline of borrowers that you know how to deal with, and that know you, and being quick. I mean, the reason people, one of the main reasons, and you know this better than I, that people are willing to pay more money and pay these higher interest rates is because they're going to get their money right now, and they want it now, and these loans are usually a year, and they're going to be paid off, but they don't want to wait for a bank to approve and.
No hassle, no fuss.
Okay, you ready for this? You want to hear how fast this can be done? Go ahead, tell them.
So I got a call Wednesday morning from one of my best referral resources. He's a top producing mortgage broker in the Bay Area. He's probably sent me 15 loan referrals this year. He calls me Wednesday morning. He's like, Mark, I need a favor. I've got this problem. I got this transaction, and everything was lined up. We had the funding lined up for this client. It's not even that big a loan relative to the purchase price, but my team messed up, and I'm embarrassed, and I wondering is it possible for you to fund a loan tomorrow?
This got to be a world record.
So, and I said, well, it's possible. Can you get me everything now?
Yeah.
And he did. He sent me an entire file. He sent me like 30 attachments. I had the loan application, the tax returns, the income statement, all of that stuff. It was a home purchase here in Marin, and what was great about it, it was a $200,000 loan request on an $850,000 purchase. So you're talking about, 25-ish% loan to value, and which we don't hardly see that low an LTV. So it's just a fabulous loan. I actually don't. I tried to find out from a mortgage guy what had happened, but he didn't want to talk about it. It was just something that happened internally for him.
Well, he was embarrassed.
He was embarrassed about it. So, but anyway, we pulled through for him, and it was and that borrower was so anxious to get the deal done because she was going to lose the house. The transaction was going to be canceled if we didn't close.
Yeah, you ever
Thursday.
been outbid by anybody there?
Yeah.
You know that happens.
So and that person had to pay the cost of that money was 9.9% and 3 points, and we rushed it through, and they're probably going to pay the loan back in 30 days because they do have bank financing lined up. It's just there was a glitch that caused them to be unable to close on the day they had to close.
You should have charged them 3% and 9.9 points.
Yeah.
Nah, I don't think that would work. Let's see.
Sometimes, I mean, like we were talking about earlier, you have to be so aggressive with your offers these days. I mean, that's sometimes people are saying, well, I'm not going to do a financing contingency because if someone's all cash, I have to be able
this
to.
person
that happens a lot.
This person was basically coming up with $600,000+ cash and just couldn't bridge that gap of the $200+ thousand loan. Now the thing is, I guess, when you do a loan that quickly, you got to make sure with the title company that hey, listen, I got to be in first position. There's got to be nothing behind me, no taxes, no.
Well, the good news is it was a title company we had worked with before. It was a title officer we had worked with before. We verified we can get the Alta lender's title policy. There was already hazard insurance was already. I mean, pretty much everything was ready to go. The escrow was already expecting loan documents, but from a bank. They were expecting from a bank. So we, there weren't any shortcuts that we took. We were able to within 24 hours. Basically create an entire loan file from scratch and get it signed off, and the borrower signed it Thursday morning, and at 10 o'clock, by 10 o'clock the documents were signed, and we executed the wire to the title company, and they closed that day. So that is among the faster of the loans we've done. But you're absolutely right. I mean, that's kind of why our business exists, that the private lending industry exists, because we're in this crazy real estate market where people are making very aggressive offers and finding out the hard way, oftentimes when their deposit's already gone non-refundable, that hey, their bank is not going to be able to close in 14 days or 21 days.
Exactly.
Yeah, your rate of return on a loan like that is through the roof, especially if it goes 30 days, because you get to keep the whole 3 points.
Well, it is. I mean, it's expensive money. You think, wow, a 3-point origination fee on $200,000 is $6,000 plus it's 10% money. Wow, that's expensive. But compared to what? Compared to losing the house, maybe losing your deposit, losing the opportunity, having to go back out and find another home to purchase. I mean, it's you gotta kind of chalk it up as added to the cost of the house, but you get the house you want.
Yeah,
Right.
and I just figured out if it goes 30 days, your interest rate is 36.825%. That's not bad.
Just like my credit cards.
All right, guys, we're going to cut to our second commercial break. We're having too much fun. This is going fast. Then we're going to get back to Brad because I want to, help see the investors. In fact, listeners, make sure you stay tuned because we're going to talk about what to look for and what to avoid when you see various offerings out there. Again, the theme is TV pets. What was the name of the dog on the Brady Bunch? All right, the first 3 callers with the correct answer. Do you know this one?
Another
It's
dog.
another dog. Okay, the last one is not. I don't know what the last one is. Okay, what was the name? What was the name of the dog on the Brady Bunch? The first 3 callers with the correct answer are going to win that free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190. What's the phone number?
888.
912.
1190. Very good. All 3 of us. Okay. Don't touch that dial. The best investing will be right back.
That was mean.
That was me. I caught you off guard. Huh?
Yeah. Oh, I should know that number by sleep.
I know.
that'd be good to talk about, what should one look for.
I could tell you about also one of my favorite things that people do when they do funds, which is
Good.
how they set. If you get a PPM with $100 million on the top, go look and see what they've actually raised, because a lot of guys like to look big by the number they put up there, but they end up not
you mean
raising.
we're doing $1 billion offering?
Yeah,
Oh, really?
Yeah.
Which is and I can tell you about this, which is I always thought it would be better to set it low and look like you're busting through this the top. You're like I thought it was going to be a $20 million offering, and I'm already through. I've already raised
I
that.
totally
I had to
agree
raise
with that.
it.
Yeah. I get a little nervous.
I used to always tell my clients, but these guys want to say, nope, I have a $100 million fund. I was like, well, no, you don't. You raised $15 million.
Yeah, that's ridiculous.
I always like what Matt Burke always says. You want to look for alignment of interest between the sponsor of the fund and the person who he's trying to raise money from. I mean, it shouldn't be weighted, too heavily one way or the other. The sponsor needs to make money, but it can't be. It's got to be good.
Right.
Ready?
Yep.
Hold on.
Hold on. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. When we get to the second commercial break, we asked this trivia question: what was the name of the dog on the Brady Bunch? Man, you guys never watched TV.
I can picture this one too. I don't know.
Tiger. Remember? Tiger.
Yeah.
Okay, whatever. Okay, so Brad, you've done a lot of these offerings. What would you advise listeners? I know you're not giving any legal advice, but just generally, you've done this a million times. What kind of things do you like to see? What to avoid?
Well, the first thing we talked about was experience in the manager and the sponsor. The other thing, this may sound self-serving, but well-written documents. If they aren't coming at you with a PPM or some sort of well-written disclosures,
private placement memorandum.
Yeah, private placement memorandum, or an offering circular, or some sort of offering document that really is thorough and describes, the terms of, the agreement that you're getting in with them, the terms of the operating agreement, what fees are going to be taken, what kind of loans they're going to make.
Okay, so it shouldn't be on a cocktail napkin where it says, you give me money, I pay you big.
Or even worse, a glossy, sales pitch.
Yeah.
So these types of investments, just to make sure that the audience understands exactly what we're talking about, these are the types of investments, also known as alternative investments, that are called things like private placements, private offerings. What other kind of names do they typically go by?
Well, that's about it.
That's about it.
Private placements and private offerings, right? Because we talked about the offering circular or the private placement memorandum, which are actually two names that really are mean the same thing. They're those thick 40-plus page documents that say, here's how we make money, here's how your investment's going to be used, and what kind of returns you can expect, and then here are all the risk factors.
Yeah, and here's who I am, and here's my experience. It doesn't, and don't be worried if you get one where it's not all accredited, because there are other ways to do this. You can qualify it. California could be an interstate offering, but generally that's the way people are going these days. I think because there are more accredited investors out there than there used to be, and
but now you're not allowed to use your home, which is a major factor. I gotta say, I gotta give a little plug here to Mark, because I actually got appointed by the Department of Justice back in '93 for a $500 million REIT that had gone bankrupt because they just got over leveraged and all that stuff. And at that point, I just sort of turned a deaf ear to any of these kind of private placement memorandums for 20 years. And then, met Mark a few years ago. We started doing the radio show, and then after a while, he about a year and a half ago, he said he wanted to start a fund, and I said, well, Mark, you're a really good guy, but, I put up all these little mini roadblocks in my mind. I said, I'll tell you what, if you will allow me to have at least some, not influence, but suggestions.
Some input.
Input, there you go, that's the word. Then I said, I would love to, talk to people about, you and your fund, and be an investor. Because that's the thing, is I get solicited all the time by this stuff, and I always say no. And after, talking to Mark, and some of the stuff I suggested and with the input, he had already thought of ahead of time because he's trying to do the interest being aligned with the investor, which is always a good thing.
Right.
That I actually decided to put some of my IRA money with, and I watched it like a hawk.
Yes.
Well, all three of us were at an event in Seattle just a few weeks back that was hosted by a company that promotes the creation of mortgage pool funds, which is a subset of the type of investment we're talking about. And what I like about what the principal of Fairway America, who's the sponsor of that event, says is that you want to look for investment opportunities that have an alignment of interests. That's very, very important. Alignment of interest between the sponsor, who is the person that's promoting the investment, looking to raise the capital, and the investors who they seek to raise the capital from. So you want it to be a fair distribution of.
Give us an example of that, because it sounds good, but putting it
Well,
in practice.
In a mortgage pool fund, you typically, the most simplest and basic form of a mortgage pool fund is there's a preferred interest return, not a guarantee, but a preferred interest return paid to the investors first, and then followed by a split of the profits or any excess monies that are earned beyond that. And so you want to look for a preferred return that is that makes sense and is normal for that market. Like, for example, in the San Francisco Bay Area here, a lot of preferred returns, 8 used to be a very common preferred return, 8%. As interest rates have come down, mortgage pool funds have been created with 7% or even 6% preferred returns. The other aspect of that would be the profit side of it. Some profit splits are weighted a little more in favor of the investor. Sometimes they're weighted in favor of the sponsor, and other times it's just a 50-50 split. So, for example, our fund, we have a 50-50 split and a 7% preferred return and a 50-50 split. But we put in our points, our origination points, half of the origination points, which is the house share, goes into the mortgage pool fund as income plus 100% of the note rate. We don't charge a servicing spread.
See, otherwise, what some people could do who have these funds, they might give a borrower a really low interest rate but charge a whole bunch of points, right? The points for themselves. So, Mark, if somebody had a fund that, let's say, had a 10% preferred return, now yours is 7% plus the profits. The average investor might look and go, well, of course I'll go for the 10% one.
Well, I got an email response today from someone who we had sent some information to, and I actually sent him a copy of the October newsletter where we showed basically the performance of the fund for 2014. And we're right now on an annualized return of about 8.15 on a monthly basis, and a little bit more on a compounded basis. You can choose either or. And he wrote back. He said, well, I really want 10%, and so I'm gonna, if you ever increase your yield, let me know. And that's not an uncommon response, because people like 10%. Some people think it's got to be awfully risky to be able to.
Sure, we'll give you a third mortgage, 90% loan to value.
And the second comment he made is as I've seen other opportunities elsewhere that offer double-digit returns. Well, yeah, they do, but they're number one, they're in other markets outside of California, and I don't know about anyone else, but I prefer to invest locally where I understand how the real estate market works here. I don't understand how the real estate market works in Arizona or Texas or Atlanta or Detroit, and a lot of people are investing in mortgage pool funds that are geared for that market, and private money is more expensive in that market, and so they can produce higher yields. And there's anything wrong with that. It's just that I feel personally more comfortable investing where I know and in what I understand.
Well, what a lot of people don't understand is all it takes is a couple of really bad loans to bring that yield from 10 or 12% down to 2%. And the whole idea to me is preservation of principal. Because your fund right now, what's the average loan to value?
We're right at 50%.
50%. I mean, I don't know if you can find any mortgage fund out there that's at average loan of 50%.
We've got some fabulous loans in there that are, where the weighted average loan to value is 50% right now. But the other thing we do is you want to know when you look at a fund, are they using leverage to produce their yields? So if they are producing double-digit yields, if they're in California, I will guarantee you they are using leverage. You cannot Have a mortgage pool fund in California that produces double-digit yields without using leverage unless you're making crappy loans. I'm sorry, that's just a fact.
Yeah, that's true.
Well,
There's just too much competition for loans.
tell you what, we're going to cut to a quick commercial break here. When we come back, we got a very interesting email for you, Mark, that has to do with prepayment penalties. Okay. Again, the theme is TV pets. What was the Flintstones' purple pet? What was the name?
Oh, I know that.
Oh, you know that one, right? That was an easy one. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What was the Flintstones' purple pet's name? All right? Don't touch that dial. The best of investing will be right back. We had to ask at least one easy one for you.
Yeah.
Dabba-doo.
Yeah, that was his name.
Technically, it's another dog, but not really. It's
You
a
know, that's the
dinosaur.
thing, it's more
Kind
dinosaur,
of like a
yeah.
dinosaur.
So the email we received for you, Mark, was: are there times when you have loans with prepayment penalties and some without them? Under what circumstances do you impose a penalty? Interesting. He had one that he had one that there was a prepayment penalty, but it was a good borrower, and they said, "Gosh, you know what? We really would like for you to not do it." And Mark said, "You know what? You're a good borrower. We won't impose it." As it turns out, the loan went long enough to where the prepayment penalty, the guarantee just came off. So he didn't have to give up anything. He still looked like a hero. Isn't that great?
Well, they did what they said they were going to do, which is they did a second and then a third loan with us. So they did three nice size acquisition loans through us. And we kind of stole.
Did the third one go through?
Yeah. We did Corte Madera, Mill Valley, and then Paradise Point and Corte Madera.
How big was the Paradise Point one?
Let's say around 600,000-ish, 650-ish. They got it for under $1 million. It was a definite fixer. It was not one that you want to move into. It was
That one just closed recently?
Yeah. It was out on that when you head out from the village and you're heading out towards Paradise. It was on the left-hand side. There's a development that's built right out onto the bay. And one of the homes that backed up against the bay, so it had a great bay view. But it was just needed some foundation work, and it was just not good.
Are they going to flip it, or are they going to turn that into?
No,
they're not going to do a.
No, they had it all. They had all the full contractor bid and
Is that
everything.
another thing I'm competing against is people just buying for VRBO?
Oh, for Airbnb, yeah.
Airbnb,
That's how they were going to run. They bought a house in Corte Madera that had 2 units, and they said that's how they were going to rent it out on Airbnb. That was their plan. But they have several San Francisco properties that they rent on Airbnb. One they're making, it's a nice property. It's I forget how big it was now, but they said they were making $20,000 a year.
Wow.
As opposed to what would have been less than $10,000
Yeah.
rent.
You guys ready?
Yeah. This is the 4, right?
This is 4. We got 9 minutes.
Okay.
All right. We'll go into your email.
Yeah.
And anything you want to cover? We'll get into. Let's ask how people can get a hold of you. The kind of people. I mean, there'd be people who would be, obviously, people wanting to start a fund. Would investors call you?
Sure, in some, but
capacity.
probably, smaller investors probably not. I mean, we represent a lot of like really big, institutional money and things like that. And usually, you don't need anyone if you're just an investor unless you just had a question or something, which is
Okay, that's all right. Still, it's always good people call you because then when you refer out to other people, it's always good. Cover the relations. Okay, here we go. Welcome back to the Best of Investing. Here's our last segment. I'm Edward Brown, your host. Mark Hunt of Pacific Private Money is my co-host. When we get to the third commercial break, we ask this TV pets trivia question. What was the Flintstones' purple pet's name? Dino. That is correct. Okay, now Mark, we received an email for you. It says, are there times when you have loans with prepayment penalties and some without them? Under what circumstances do you impose a penalty?
So in hard money, whether you have a prepayment penalty on a loan or not typically depends on the source of that private capital that's used to fund the the loan. So, for example, we fund our loans in one of two ways. Historically, when we started out in 2008, we used private individual capital that would go directly into that individual note. So if a borrower came to me and wanted to borrow, say, $100,000, I would underwrite the loan, and if we approved it, we would then go out and find an individual investor who wanted to be the lender on that note. So their name would go on the note, their name would be on the deed of trust, they would be the private lender on that note. If it was a larger loan, maybe we would fractionalize it and put, 2 or 3 or maybe even 5 or more individual lenders into that note. All of their names would be on the note and the recorded deed of trust. Now, typically when individuals would invest in an individual note, most brokers would require from the borrower that they guarantee a minimum interest period. And for years, 6 months was very common. A 6-month minimum interest guarantee was a very common requirement for a loan. And the reason for that is because people investing in notes, they don't want to invest it for too long. Many of them don't want to go more than 1 year or 2 years, but they also don't want it back in 1 or 2 months because there's a lot of work making the decision to invest in a note. You want your money to perform and work for you for a while. So that's one way to fund a loan. The other way is through a mortgage pool fund, which we do have at Pacific Private Money. We have the Pacific Private Money Fund, which we use to fund loans when we have liquidity. We get liquidity when we get new investors, and we have liquidity when the short-term loans we make get paid off. Now, in a mortgage pool fund, it's not unusual to make loans with no prepayment penalty. Now, from a marketing perspective and from a business model, I like making no prepayment penalty loans because my borrowers like them. I'm more likely to get the loan and less likely to lose it to one of my competitors if I can say, hey, you can pay it off whenever you want. And so that's typically the case with our mortgage pool. And as I shared earlier, in our mortgage pool fund, since the fund earns half of the origination fees on the loan, the fund actually profits by making short-term loans. So whenever a 30 or 60 or 90-day loan proposition comes to our company, we typically will try to make that loan in the fund so that we can, number one, offer no prepayment penalty, and number two, when that loan gets paid off, we can then turn around and re-lend it out and earn additional fees for the fund, and it helps us, create that yield that we're able to provide for our investors. So whether or not there's a prepayment penalty on a hard money, also known as a private money loan, really depends on the source of the capital. If it's private individuals whose names are on that loan, you'll typically see a requirement for a minimum interest guarantee, and if it's from a mortgage pool fund, it's usually going to be no prepayment penalty. So
that answers the question. Do you have any questions for?
No, I was just interested to hear you say hard money. People have all changed it to private
Private
money now.
money.
Isn't that great? Well,
no one wants to say hard money.
Yeah.
Because really, hard money from 10 years ago does not exist anymore. It really does. And it kind of does, but really all those new Dodd-Frank regulations, all the new restrictions on lending, they cover now those of us that used to call ourselves hard money lenders. And so the whole private money lending industry, I think, is that softer, easier to swallow kind of name. But it also reflects that we are now a regulated industry. It's we're not making basically no documentation, equity only, 12 points and 10% interest type of stuff, or 18% interest, which is very common 10, 15, 20 years ago. It's just it's a different industry. I think the name has changed to reflect that.
Brad, what advice would you give our clients? Any last minute advice before we hang up here?
Well, make sure that whatever you invest in, that this is more of sounds like an investment advisor than a lawyer, but just make sure it's suitable for you. These are risky investments, and just do your due diligence. I mean, find out, know who this person is that's running this thing.
Well, it depends on risky. I mean, there's going to be some that are going to be riskier than others.
That's true. But they're all going to be riskier than, say, a CD. you
Well,
won't make any money.
Yeah,
but,
exactly.
But it's a lot less risky.
It's funny because when I get phone calls from people who maybe hear the radio show or hear one of our ads, and they'll call up, and the first thing they'll ask is it risky? The answer is, well, compared to what? It's risky compared to a CD. I think it's less risky compared to the stock market. If it's a private placement that's for development of real estate, which our fund is not, we only lend money in our fund, but there are other funds that are put together for the purpose of investing in real estate. Maybe it's investing in one big project, maybe a ground-up construction, a commercial construction, or apartment building, or it might be a fund that's where the sponsor wants to go out and buy, fix, and flip with using that money, and then the investors would then maybe get an unusually high rate of return. Maybe it's 12 to 15%. You might even heard 20% yields produced. But so the risk really, but there is definitely a relationship between how much they're offering to reward you and the risk. So anytime you see over double-digit returns, you're generally going to see higher
but here's
risk.
the other thing is that you can say, okay, well it's less risk, it's more risky than a CD, but I can almost guarantee you that if you put all your money in a CD, you're not going to be happy, because not only forget the interest rate, just inflation, between inflation and taxes, you will go broke. Unless you have $100 million in the bank and only spend $100,000 a year, then you're probably not going to go broke. But everything's all relative. So Brad, the attorney, we'll call you Brad the attorney, Brad Rogerson.
I've been called worse.
Yeah. I don't know. There's nothing worse than an attorney. I'm just kidding. So how do people get a hold of you if they wanted to ask more questions?
Oh, well, I'm at Hanson Bridget is my firm, and you can go to www.hansonbridget.com and just look me up. My full name is Kent Bradley Rogerson, so I think I'm under K. Bradley Rogerson. It causes no end of confusion. And you'll see a little more about me, and then my email is right there and my phone number.
Anyone ever say you look a little like George Clooney?
No, but thank you.
Yeah, not a bad looking guy. Me, Mark, we have faces for radio. You got a little bit better face there. Mark, you got 10 seconds. Anything? How do people get hold of you?
Yeah, so for more information, go to our website, pacificprivatemoney.com. If you're a borrower, if you're an investor looking to earn 8% or more on your savings, go to our investor website, which is pacificmoneyfund.com. That's pacificmoneyfund.com.
All right, here's our thoughts for the day. A lightning bolt generates temperatures 5 times hotter than those found on the sun's surface. That's incredible. I didn't realize that. Ouch. Yeah, well, that's my next thing is going to be an ouch. Ready? And your body is creating and killing 15 million red blood cells per second. Now, ouch, that hurts.
Wow.
15 million per second.
No wonder I'm so
Yeah, there you go, exactly. Hey, but I'm pumped. Okay, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. And that's a wrap.
All right.